Now we have to go by the some problems so that you get the clarity on what the valuation rules you have done with. Before I get into this particular problem, let me quickly sum up what we have discussed so far. We have discussed on valuation of immobile property from rule 3 to 8. Rule 8 comes into play where you are asked to take the fair market value of that particular property as a value of the property in a situation where your unbuilt area is in excess of the specified area as a percentage of the total aggregate area. The percentage of the default is more than 20%, then you don't go by valuation prescribed from rule 3 to 7, then you adopt rule 8. As far as rule 3 to 7 is concerned, first you have to look at the actual rent. In case if the actual rent is getting reduced because of the factors like tenant agreeing to pay the municipal taxes, tenant agreeing to carry out with the repairs, and then tenant giving interest free deposits, tenant paying premium, or tenant meeting the obligations of the SSC, for all these adjustments are being prescribed, then you get the actual rent, and your gross maintainable rent is the highest of what? Municipal rental value or the value as we calculated as the actual rent. And from the gross maintainable rent you have to reduce municipal taxes and a standard deduction of 15% of the gross maintainable rent. That gives you net maintainable rent, and you have to capitalize the net maintainable rent either with 12.5 or 10 or 8. 12.5 when it is a freehold land, 10 when leasehold land, and unexpired lease period is more than 50 years, and if unexpired period is less than 50 years, then you have to multiply with the 8, whereby you get capitalized value of the net maintainable rent. But for one particular property, that is you can go only by the capitalized value of the net maintainable rent. For all other properties which are constructed after 31/3/1974, the rule is capitalized value of the net maintainable rent must be compared with the actual cost of acquisition plus improvement cost. Whichever is higher, you have to take that as the value of the immobile property. But for one property, the exception is that provided you use that particular property for your residential purpose, 12 months before the valuation date completely it must be used for the residential purpose, and where the cost is less than 50 lakhs or 25 lakhs depending upon the metro or other than metro. Then to this particular valuation you have to make adjustment for unbuilt area, then you have to make adjustment for unearned increase in the value of the leasehold land. This is the standard procedure for carrying out with the problems. Any procedures you will be getting only by your writing that particular procedure for many number of times. At this juncture we will do with 1 or 2 problems, and in your previous examination question discussion we have got good number of problems on valuation of a immobile property. So you can take one representative problem. Write down Mr. X is the owner of commercial house. Mr. X is the owner of the commercial house built upon plot of 1000 square yards. The plot has been taken on lease. The plot has been taken on lease from government. He has built up in 1976, 1976, 240 square yards, 240 square yards of the area at a cost of 1,70,000. The house has been let out for commercial purpose. At a monthly rent of 1,000 per month. Tenant agreed to pay. Cost of the repairs. Then give a deposit of 20,000. Give a deposit of 20,000. Refundable after 7 years. Then municipal value of the house is 9,000. Municipal taxes levied at the rate of 12% to be borne by the assessee himself. Government has notified 300 per square yard as unearned increase. Then 40% of unearned increase. It charges on transfer of the house. The unexpired lease period is 70 years. Unexpired lease period is 70 years. So this problem we are solving with what intention? For us to understand what theoretically we have studied. I am not trying to make you to copy down the solution. I will only explain the approach. You just see the approach here. It is being actually let out for what value? It is being actually let out for 1,000 per month. 1,000 into 12, just listen, don't write. You can very well remember, and these type of questions are available in n number of textbooks. Approach is most important. We are not bothered about the figures. What is the actual rent? Why then you made us to write the question, sir? Because when I am giving the explanation for the solution, you should feel the question. There is no way by which time permits us to copy the solutions, nor it is warranted. Actual rent 1,000 per month, 1,000 into 12 is equal to how much? 12,000. To this 12,000, what adjustments you need to carry out? What adjustments you need to carry out? Municipal taxes, who is bearing? It is the SC only is bearing, so no addition for that. Repairs, who agreed to bear? It is a tenant who agreed to bear the repairs. So 1/9 of the actual rent. 12,000 into 1 by 9 makes it to 1,333. Then he also gave a interest free deposit, because it is not advance rent for 3 months. If it is advance rent for 3 months, it would have been only 3,000 rupees. But it is more than 3 months of the rent, 20,000 rupees of the deposit he has given. So on that 20,000 at the rate of 15%, 3,000 you have to add. Put together with these additions, the actual rental value comes to 16,333, which is to be compared with the municipal valuation. Municipal valuation for that property is what? Only 9,000. So which is higher? Actual rent 16,333. After you ascertain that actual rental value, comparing the same with the municipal valuation, whichever is higher, that you call it as a gross maintainable rent. What is your gross maintainable rent? 16,333. And from that you have to reduce what? 15% standard deduction. 16,333 into 15% makes it to about 2,450. And municipal taxes is to be calculated as a percentage of the municipal rental value. 12% of that 9,000 works out to be about 1080. These two must be deducted and net maintainable rent works out to be 12,803. You have to capitalize the net maintainable rent. It is a leasehold land where the lease period is in excess of 50 years, 50 years, then you have to multiply with the 10. So 12,803, if you multiply with the 10, it works out to be 1,28,030. But since this is a property which is constructed after 31/3/1974, what the law says, you have to compare the value you ascertained with the actual cost of acquisition or improvement. What is the actual cost with which he constructed the house? 1,70,000. He constructed the house with 1,70,000. Which is higher? 1,70,000 is only higher. So you have to take the value of immobile property as 1,70,000. Now the question of making addition for, what is it? Unbuilt area. What is the total area? 1,000 square yards. You constructed the property with what area? 240 square yards. Unbuilt area is how much? 760 square yards. Isn't it or not? 760. So if you have got the calculator, then it is in which city, friends? It is in the city of Delhi. So Delhi means metro. 60% of the aggregate area is the specified area. That means you can have an unbuilt area of 600 square yards. Of the total 1,000 square yards, 60% is the specified area, means permitted unbuilt area is how much? 600 square yards. Whereas your unbuilt area is how much? 760. Because in how many square yards you constructed that particular house? 240 square yards you constructed the house. So 760 is the unbuilt area, actual unbuilt area. Permitted unbuilt area, that is the specified area, is how much? 600. So from 740, if you reduce 600, you get 140. That 140 is to be compared with what? Total aggregate area. 140 divided by total aggregate area is 1,000 square yards into 100. So what is the percentage of the default? 14% is the default. 14% falls where? In between 10 and 15. In between 10 and 15. So in between 10 and 15, if the percentage of the default is there, how much you have to make an addition? 30% you have to make an addition. So to that particular 1,70,000 you have to add 30%. That 30% works out to be 68,000. So put together it comes to 2,38,000. Now the next adjustment is for unearned increase in the value of the land. how do you calculate the unearned increase in the value of the land? That is, what is stated about the value, that is 300 per square yard. Total 1000 into 300 is how much? 1000 square yards. Per square yard, what is the unearned increase, what they are saying? In the problem, the government notified 300 square yards as unearned increase. So 1000 into 300 is how much? 3 lakhs. And government charges how much for transferring the property? 40%. So that 3 lakhs into 40% works out to be how much? 1,20,000. But in any case, it cannot exceed 50% of the, what is it, your 2,38,000. So 50% of 2,38,000 of the value what you have calculated after making addition for unspecified area and all, that works out to be 1,19,000. So whichever is less, which is least, 1,19,000 you have to add. Thereby you get what is it, the value of that particular property. So these are the adjustments which you have to carry it out. So the next issue for us is like doing one more problem. Write down, of course for this the solution you can write as what? Hints you can write, that is actual rent after making adjustments 16,333, net maintainable rent, what you need to do for the net maintainable rent. The hint here is net maintainable rent comes to 12,803. Then capitalized value of net maintainable rent comes to 1,28,030. Then adjustment for the specified area is, adjustment for unbuilt area is 68,000. Then deduction for unearned increase, 1,19,000. 1,19,000. So friends, for unearned increase it is not you have to add the value, you have to reduce it. Please do remember, for unearned increase you are not supposed to add. For this unearned increase you have to calculate and you have to reduce it to ascertain the value of the house. Make a small note. We have to reduce from the value of the immobile property, from the value of immobile property, amount for unearned increase. Amount for unearned increase. I move to the next question, friends. Here I am expecting you even not to write the question also. Whenever I say you should not write the solution, you should not write the question, please do remember, if you are a e-video student, stop the lecture, have a cool tea, come back. Cool tea means coolly you take a hot tea and come back and sit and listen carefully the question. Question, I read it like this: X is the owner of the house. See, once upon a time, yes, today probably Krishna Reddy may feel What a punishment I am having by sitting in a class like this. But Mr. Krishna Reddy, please do remember, you are a person born in great India. Before the Britishers came to this particular land, the situation is like, there is no book concept. Veda Bhumi. In that, teacher will chant and teacher will tell and the Sishyas will be chanting it. In that process, they used to get the education. That is the reason why old generation people, memory is more. Because their mind is not given a comfort of memory option which you have in the computer today. They have to memorize in their main chip only. There is no secondary storage. Everything is in the primary storage and their primary storage is also very big. Now slowly we are trying to decrease our primary storage and everything we are keeping it in the secondary storage. See, initially it is difficult without being put on the board for us to listen and understand, but you have to do with it. Other way around, you will be going on writing and the module will go to 250 hours. So listen carefully. X is the owner of the house which is constructed on a leasehold land acquired from Delhi Development Authority. So basically he constructed a house on a leasehold property. Immediately the mind should say what? If the lease is more than 50 years, with 10 I have to multiply. If it is less than 50, with 8 I have to multiply. Like this, good ideas if they are coming means we are passing. Concept is going into our mind. Okay. He has let out this house for 12,000 per month. Very good. Now, to whom he has let out? To Y. To the Y will give interest free advance of 1 lakh which will be given to him at the time of vacating the house. So at the rate of 15% you have to calculate the interest and should add the same to the actual rent. Then Y will also pay 50,000 as a premium for leasing the property for 5 years. That means that is 50,000 divided by 5 is equal to 10,000 per annum you have to add to the actual rental value. The annual value assessed by the local authority is 1 lakh. You have to compare the actual rent with the municipal valuation, whichever is higher you have to take. Taxes levied are 15,000. So this from the gross maintainable rent you have to reduce. Why spend 35,000 on the repairs of the house? You are not bothered with the actual repairs. 1/9 of the actual rent you are going to add before you calculate ascertain the gross maintainable rent. Actual rental value you have to add 1/9 towards the repairs agreed to be borne by the tenant. Then the difference between the unbuilt area and the specified area is 14% of the aggregate area. Thanks, he only has given. So that means in between 10 and 15% means 15 into 2 is equal to 30% you have to add for what is it, unbuilt area. Then X paid 80,000 for acquisition of the land, but now DDA valued the land on 31/3/2012 is 4 lakhs for the purpose of unearned increase. So unearned increase is what? 4 lakhs minus 80,000 is equal to 3 lakhs 20,000. And DDA charges 50% of the unearned increase for transfer of that particular land. So 3 lakh 20,000 into 50% is how much? 1 lakh 60,000. So the unexpired period of the lease is 85 years. This information is useful for that finding out the capitalized net maintainable rent. Compute the value of the house property. So there is no suspense here is a straight problem. So answers how the pro forma they have developed is like, what is rent, add in case if the municipal taxes are borne by the tenant. If the SSE makes the municipal taxes, nothing is to be added. Add 1/9 of the actual rent for repairs. Add 15% of interest on the interest-free deposit. Add premium, that also 1/5 of the premium. Then you get the annual rent. Annual rent. And then from there you have to reduce the municipal taxes borne either by the tenant or by the landlord, and 15% of the standard deduction of the gross maintainable rent. Then you get the net maintainable rent. That net maintainable rent you have to capitalize with 10. It will give you the capitalized value of net maintainable rent. Since this is a property which is constructed after 31/3/1974, you have to take the actual value of its construction, whichever is higher you have to take. To that you have to add 30% towards the unbuilt area. From there you have to reduce the for unearned increase. Unearned increase. Unearned increase, how you will calculate? What is unearned increase? Or 50% of the value after making the adjustment for the unbuilt area. Whichever is least, that amount you are going to reduce it. So this is how you have to go by the valuation of immobile properties. Since already I have given you the pro forma of how do you need to do it, I am not again making you to write. But anything comes only out of practice. It is a simple procedure. There is nothing great that it can't be understood. It is to be memorized. So that memory happens only when you write 2 to 3 times and explain to your friend while traveling in a bus or sitting in the office. Please listen, I will explain how to value the immobile property for the purpose of the wealth tax. Do such, and whenever you are free, go on writing on a piece of paper and throw that paper out. Like that only you have to remember the procedures. Now friends, I move to the rule 14, valuation of the assets of a business. Let us suppose you are having business. In that business you have got a balance sheet. In that balance sheet you have got the assets. In our last session also I said, in the business balance sheet what assets you have to take for the purpose of the wealth tax? Only the immobile property and motor cars. Except for the immobile property and motor cars, rest of all are not assets for the purpose of the wealth tax. Of course cash is there. Cash and jewelry, bullion, like such things are there. Then you will include it. So as far as cash is concerned, for company assets, what is all that is recorded is not an asset. Unrecorded cash only is the asset. For individuals and HUFs, in excess of 50,000 cash you have to include in the net wealth. As far as the business assets are concerned, how do you go friends? If it is a depreciable asset, what is the written down value as per the Income Tax Act? If it is a non-depreciable asset, what is the book value? If it is a urban land held as a stock in trade, but for more than 10 years it is still there as a stock in trade, then you have to go by the value as per the income tax. These values again are to be compared with what? That is if it is a house property, as per rule 328 you have to adopt that rule 328 and calculate the value, book value or rule 328 value, whichever is higher that you have to take. If it is a jewelry, you have to go by rule 18 and 90 jewelry valuation or the book value. And if it is a urban land or motor cars or assets, boats and aircrafts, what is the book value or the fair market value? Because for the assets for which valuation rules are not prescribed, rule 20 is applicable, and what that rule 20 says, that the assets for which valuation is not possible, you go by the fair market value is a point. So if the value is going to exceed the book values, then what need to happen is you have to go by the schedule 3 valuations. Other way around, you have to go by the book values only. This is all what is being stated for the valuation of the assets of the business. So write down rule 14. Valuation of the assets of the business. Valuation of assets of the business. This is applicable for all SSEs and we need to carry out this valuation principle. We need to carry out this valuation principle for each asset. For each asset. Then we should compare value as per this rule, value as per this rule 14, and value of those properties as per schedule 3, value of those properties as per schedule 3, and in case if the value as per schedule 3, if the value as per schedule 3 is in excess of 20%, then schedule 3 value is to be taken. Now value as per this rule, A, depreciable assets, written down value. B, non-depreciable assets, book value, non-depreciable assets, book value. Third, urban land held as a stock in trade, after 10 years, value adopted for income tax, Then for these assets, what is the schedule 3 value? Write down schedule 3 value. House property, rule 3 to 8. Jewelry, rule 18 and 19. Then third, urban land, motor cars, hatchets, boats and aircrafts. Rule 20, that is fair market value. Then note, debts incurred on the assets included in the net wealth, are to be reduced, are to be reduced. Then friends, try to understand, in case if a debt is not specifically taken for a particular asset which is included in the net wealth, then what you need to do is total debt you divide with the actual cost of all the assets and non-assets and multiply the same with the actual cost of the assets included in the net wealth. So that principle when you need to apply, when debt is not specifically taken, generally debt is taken which is used both for the assets included in the net wealth and assets not included in the net wealth, then proportionately you have to take that particular debt and reduce the same from the net wealth. Write down that point. If debt is incurred on an asset, if debt is incurred on an asset, then the following debt is deductible. If the debt is incurred on an asset and non-asset and non-asset and non-asset, where it is not possible to compute the debt utilized, where it is not possible to compute the debt utilized for acquiring the asset, then debt deductible is equal to, then debt deductible is equal to total debt divided by actual cost of assets and non-assets, assets and non-assets multiplied by, whole multiplied by actual cost of the assets, actual cost of the assets, actual cost of the assets. Now friends, I will just read one question for you where we have to go for the valuation of the business assets. There is a company which is engaged in the manufacturing business as well as construction and sale business also. It is having both manufacturing as well as real estate. Submits the following information. Imported motor car, book value is 13 lakhs, market value is 11 lakhs. First, as far as motor cars are concerned, what you do? Motor cars are assets which are to be included in the net wealth. So when its market value is 13 lakhs, its book value is 30 lakhs and market value is 11 lakhs, whichever is higher you have to take. Which is higher friends? That is the book value of 13 lakhs is higher, so take that 13 lakhs. And then motor cars for the directors. For directors use, if motor cars are being given, then they are also to be included in the net wealth. Unless that motor car is used for hire business or that motor car is held as a stock in trade, all other motor cars are to be treated as assets. Either their book value or the market value, whichever is higher, you have to take. That's what, who said so? Rule 20 says so. Then friends, vacant land in rural area located within 5 kilometers from the Delhi. When you say it is a rural land, if it is beyond the municipal limits of that particular city, but if it is not beyond 8 kilometers, it is well within the 8 kilometers, that is only within 5 kilometers of that particular city, if that particular rural land is there, it is as good as an urban land only. So for that 10 lakhs is the book value, market value is 16 lakhs. So you go by the urban land valuation, how it will be. Rule 20 just now you have written. As far as that rule 20 is concerned, it says fair market value. For which assets you have to take fair market value? Other than your house property and jewelry, you have to take either the book value or the fair market value by adopting rule 20. Then vacant land in Delhi on which construction is not permissible. Once urban land on which construction is not permissible, there is no question of looking at the values. Straight away in the note below the answer you will write this is not an asset. Then land held as a stock in trade which is acquired on 1/1/2000. If it is acquired on 1/1/2000, already 10 years period is over. So for that you have to take the market value or the book value. Book value here is 20 lakhs whereas market value is 18 lakhs. Book value is what is it 10 lakhs and market value is 15 lakhs. Then 15 lakhs you will take. Similarly, land held as a stock in trade acquired on 1/1/2004. Still 10 years period is not expired. Then if land is held as a stock in trade up to 10 years, it's not an asset. Aircrafts for use of the directors. Aircrafts are assets. Then you have to go by book value or the market value. Book value is 86 lakhs and market value is 98 lakhs. So you are asked to take what value? Aircrafts for the use of the directors, that is 86 lakhs and the market value is 98 lakhs. You have to go by what? What is stated? Urban land, motor cars, assets, boats and aircrafts, fair market value. And then jewelry 61 lakhs. As far as jewelry is concerned, what is stated as far as jewelry is concerned? Jewelry, bank balance, cash in hand, plant and machinery, factory building, flats held as a stock in trade, these are not considered as assets. These are not considered as assets. More particularly jewelry, if it is held as a stock in trade. What we are discussing is business balance sheet. In the business balance sheet, jewelry is there means what? It is to be not it is to be treated as it is being held as a stock in trade. If it is not treated as a stock in trade, yes friends, then you have to go by the valuation only. So jewelry, bank balance, cash in hand is 75 lakhs. Since this is a company and it is an recorded cash, it is not to be treated as an asset. Bank balance anyhow is not an asset. Plant and machinery is not an asset because for the purpose of the wealth tax only 6 assets are there. So in that 6 assets list your plant and machinery is not there. And then factory building. Factory building is also not an asset since it is being used by the SSC for the purpose of his business or profession. Flats held as a stock in trade. Flats held as a stock in trade is not an asset. 4 identical flats given to the employees whose salary is 4 lakhs per annum and salary of the one of the employee is 6 lakhs per annum. 40 lakhs is the book value and schedule 3 value is 60 lakhs. So you have to take 60 lakhs, but for 3 properties they are not considered as assets because they are being let out to the employees, and here the SSC is a company SSC, and so from that 60 lakhs divided by 4 into 3 is equal to how much? That is 45 lakhs you have to exclude, only 15 lakhs you have to consider is a point. Then friends, bungalow given to the director on rent for the entire year. Director salary is 10 lakhs per annum. Then bungalow given to the director for 300 days or more. Once it is a residential property let out for more than 300 days, then it is not an it is being exempted, is more important, you should remember. Exemption is there, it is an exempted asset. Then friends, plot of land of 400 square meters 5 lakhs is a book value, schedule 3 value is 9 lakhs. One plot of land below 500 square meters, you can take that as a, what is it, an exemption, but is the exemption available for the, what is it, company SSEs? No, it is for the individuals and HUF. So on that pretext it is being included here. So who is the SSE? You should be very careful. So these are the points. Of course most of the points are the one which we have discussed earlier also. So our first session is very, very important. What is to be treated as an asset, what is not to be treated as an asset, you have to be very careful. When you sit in the exam, you should understand that in a business balance sheet, jewelry is appearing means it is to be taken as a stock in trade. So on that pretext it will not be treated as an asset. Similarly, factory, building, plant and machinery, these are also not to be treated as an asset. That question I am not making you to write for the simple reason that is basically dealing on your knowledge of asset. What is asset, what is not an asset. Then comes to the point of rule 14, which gives you the valuation for the business assets. That is precisely the point.